Welcome to another edition of Global Tax Talk. I'm Berber. My co-host Giorgia Maffini is joining me from London. Welcome, Giorgia.
Thank you, Ege, and great to be with you as always.
Many companies have net zero and carbon neutrality goals to accelerate global decarbonization and deliver sustained outcomes on climate change. At the same time, green taxes, incentives, and broader carbon pricing regimes are proliferating worldwide as governments look to reach their own environmental targets. Giorgia, let's start by level setting. Would you please provide a top-level explanation of what's happening around the world in this space?
Thank you, Ege. So governments and supranational organizations have implemented ambitious targets for reducing carbon emissions. The question is, how do governments make sure that the economy and society as a whole achieve these targets? Broadly, governments have three sets of tools available. The first set of tools aims at increasing the price of carbon-intensive activities, and you do this with carbon prices that can be either taxes or you would have to introduce an emission trading scheme. The second set of tools is about reducing the price of less carbon-intensive, cleaner activities, and you do this with incentives. The third set of tools is about protecting local greener producers from the competition of outside producers that could be producing cheaper goods, but goods that are more carbon intensive. And you achieve this protection with either a tariff like the CBAM in Europe, but you could also implement a real carbon border adjustment. At the moment, around the world, carbon pricing scheme, so the first set of tools, is the most popular. There are over 70 carbon pricing schemes in nearly 50 countries. For example, China has an emission trading system that has been in place now for 2 years and a half. It recently issued the first administrative regulations for this national ETS, regulations that will be implemented on the 1st of May this year. The EU's emission trading system is the world's biggest carbon market by traded value, and the European Union has recently announced plans to launch a task force of experts that could help countries outside the bloc to launch a similar carbon market. More countries are looking to follow suit. For example, Nigeria has recently announced its plan on carbon market activation. A related trend is the rising number of carbon credit markets. For example, very recently, Taiwan has opened trading of international carbon credits from 7 countries in Asia, Africa, and South America, and these international carbon credits are available for purchase to local enterprises.
Thanks, Giorgia. Carbon prices, incentives, and carbon border adjustment mechanisms may have significant implications for the business, including not only the tax burden and reporting obligations, but also reputational concerns. We've already entered the preparatory phase for the world's first carbon border tariff, the EU CBAM. The EU CBAM is the EU's landmark tool to fight carbon leakage and one of the central pillars of the EU's ambitious Fit for 55 agenda. The next deadline to submit the CBAM report is 30th of April. Giorgia, what have we learned from the first CBAM reporting deadline in January?
Thank you, Ege. So CBAM in Europe is now up and running. We are in a transitional period until 2026. And in this transitional period, there are only reporting requirements, with actually the deadline for the first reporting period being in theory the 31st of January this year. In reality, the EU CBAM reporting platform has experienced some technical issues, and this has caused delays with importers trying to submit their declarations. So as a result, the European Commission has allowed importers to request a month's extension, but we don't really expect this to continue. So the next reporting deadline is the 30th of April 2024. The good news here is that there are no penalties for delayed submissions due to technical errors, and reports can be corrected until the 31st of July this year.
Let's switch gears to ESG and sustainability reporting more broadly. The business community has been focused on potential reporting obligations under the EU Corporate Sustainability Reporting Directive. Earlier in 2024, a provisional deal was reached to delay certain reporting requirements under this directive until June 2026. Giorgia, would you please briefly explain some high-level requirements under the directive? Also, why should tax executives be involved in this process?
So the EU directive requires listed companies to disclose certain information regarding social and environmental issues as part of their financial statement. The directive was adopted in the European Union on the 31st of July 2023, so last year, and as always, member countries have about 12 months to transpose the directive into their national law, so that will take us to July this year. Importantly, the first financial year is in scope is 2024, and reports are due the year after, in 2025. We are looking here at general standards that go across sectors, but these standards will be followed by sector-specific standards, as you mentioned, to be adopted at the end of June 2026. Now the question is, which companies are in scope? So European companies or listed companies on EU-regulated exchanges are in scope. Unlisted EU companies that are large are also in scope, but also some non-EU headquartered companies that meet certain tests could be in scope, although the directive has different exemptions that can apply. What needs to be reported? There are 86 specific disclosure items that range from your targets to reduce greenhouse gas emissions to the impact that the company has on sustainability matters. Sustainability matters to be intended as environmental sustainability matters, but also as social sustainability matters. And to respond to your question, tax executives definitely need to be involved. It's true that the directive does not contain a separate reporting standard for tax, but reports may need to contain tax. For example, because we expect higher green taxes to affect the business and its value chain, but the idea is here that companies need to carry out a so-called double materiality assessment to determine which sustainability issues are most important for them and their stakeholders, and clearly tax could be one of them. For the key and material sustainability issues, then the business must be transparent about their strategy, the policy, the goals, and the governance. So overall, again, this is a very quick overview of the EU Corporate Sustainability Reporting Directive, and it's back to you.
Thank you for sharing your perspectives. For more information, be sure to listen to Will Morris every week for 60 seconds on key global tax policy insights for the coming week. We'll be back soon with another episode of Global Tax Talk. Thanks for tuning in so you can stay global tax ready.